In this video, we'll look at three different types of crypto day trading strategy or arbitrage trading strategy over on Binance. We're going to look at what these strategies are and some of the risks of them, and also potential profits as well, including kind of how they work under the hood. I'll leave timestamps for each of the strategies down in the description. Crypto actually gives us really great opportunities to trade between the different markets, the spot market, the futures market, and also the futures delivery market. And between all of those different markets, the different prices that we can actually arbitrage away. In fact, Binance give us essentially all of the different arbitrages that can happen. So we'll look at that throughout this video. I'll leave a link to Binance in the description. If you're new, they give a deposit bonus and trading bonus up to $600. So check that link down in the description. The first type of arbitrage is called a funding arb, and we'll go through that now. This is where you take the difference between going long in the spot market and going short in the futures market. Now, something really interesting about crypto, especially with perpetual futures, which you get in crypto. So obviously perpetual meaning no delivery, forever. So what we see here is a very standard market, whether it's on Binance or any other exchange, is Bitcoin US dollar tether perpetual futures. Because of discrepancies between supply and demand in the futures market versus the spot market, there may be discrepancies in the futures price versus the underlying that it's tracking, which is in this case is Bitcoin, as you can see on the left hand side. So what futures do, what perpetual futures do, is they have this thing called a funding rate. Now, what that essentially tries to do is to coerce the market into going a certain way to make sure that the futures price comes back in line with the spot price. And so it's either positive or negative, right? When the funding is positive, it means that if you go long in the futures, you have to pay this funding. So if the market is very bullish and the futures price is higher than the underlying price, you're going long with the market, you're pushing the futures price up too much, and so you're having to pay extra for that. Now, the opposite of that is if the futures price is positive here and the futures price, basically the system is trying to bring that price down in line, you can go short and actually get paid to do that. So it's like an incentive where if the futures price, like if the market is too long and the futures price is getting a little bit too hot, the system tries to incentivize people to go short and bring that futures price back in line. Now, we can take advantage of these price discrepancies as well. So this is exactly how it works in terms of the underlying. What we can do here is go long in the spot market. So we would take a long position, let's say $10,000 worth of BTC. Now you go short in the futures market as well, the exact same amount, so 10,000 BTC. So in general, you should have a neutral position. So you're not actually taking like a delta position, like a position where you're either long or short on Bitcoin. You should be, for the most part, long 10K and short 10K, meaning that the price isn't going to, make a profit or a loss for you. But what you can do is collect the yield that you're getting from that short position. So as you can see down here, what we have is you can actually go to information, I think it's information, and then trading data, and it's going to give you this screen. So what we can see here is the funding rate arbitrage, and Binance is great because it literally just gives us this info. We don't have to work it out. So for Bitcoin, what you can see right here is that there is indeed at the moment a funding rate arbitrage, and it tells you the portfolio that it would, it would make up here. You buy Bitcoin US dollar tether, so you go long in the spot market, and we're doing a position size of 10,000 here just as a just as a way of seeing this. So you go long in the spot market, Bitcoin US dollar tether, and you go short in the perpetual market. And as you can see here, the arbitrage data is giving us a yearly yield of around 2.65%. So you're getting paid 2.65% as an APY or an APR to go short in the futures market to bring that market more in line. But you can also net off your position by going long in the spot market. How would that actually work in practice? Well, firstly, you'd need to go and open the long leg of the trade, which is this one right here, with the amount that you're trading. So let's say $10,000, as you can see here, $10,000 USDT, which opens a trade around 16,845, which would be, as you can see, 0.59 BTC. So we have a long position of 0.59 BTC. Now what we'd have to do is go over to the futures market and take an exact opposite position, so $10,000 as a short position. What we could do is either use leverage or not. If you don't want to use leverage, that would be a $10,000 short position, 1x leverage, so you'd need $10,000 to cover that position. I'm going to show you, just as an example, with 5x leverage as well, how this changes things. I don't recommend leverage. It's up to the individual if they want to use it. But as you can see, leverage here, 5x, means that we can put less down to open that position. So we require less for that leg of the trade. So I'm going to go to the calculator here, because when you're using leverage, the thing to watch out for is the liquidation price. So let's say we have a trade right here. So we're looking at 0.59 BTC, 0.59, and the open price is 16,845. We're actually going to get a little bit cheaper price there. So 16,839. It's going to be slightly different, which is one of the risks, right? You're not going to get the exact same trade, so you have to factor that in to your costs. It may actually work out a little bit positive for you. It may not, depending on that spread, so just watch out for that. But we'd take a short trade right here, and we can see the entry price is 16,839. 16,839, and we're trading around 0.59 BTC. So if we calculate this, what we can see is we're going to put 2,000 here, and we're going to calculate that. So if we had $2,000 in our account, you can see that if we take that short position with 5x leverage right here, our liquidation price is around 20,000. Now that's great, because it's actually, you know, quite a way away from the entry at 16,000. In terms of this, what you have to be careful of is you'll be going to, you're long in the spot market, you're short in the futures market, you have a neutral position, and hopefully you're earning that yield, which is like 2 to 3% right now. But because you're short here and you're leveraged, you could get stopped out if the price rises, even though you should be balancing the short and long, so you don't have a net position. But this can still be stopped out because of the leverage that you're using. So what I would absolutely do on this trade is to make sure that we have a stop loss way below the liquidation price. If you get liquidated, you're going to be paying fees and liquidation fees. It's going to wreck you, because the fees that you're paying are going to wreck any funding arb that you've made. So essentially, the more leverage you use for this leg of the trade, the lower down your liquidation price is, and the more risk it has of being stopped out of your trade earlier. The whole point of a funding arb is essentially to leave this running for as long as possible and collect the funding for as long as possible, because that's the trade, right? The arb, the funding arb. So the more leverage you use on this, the lower this liquidation price is, meaning that basically the quicker you're going to get stopped out of this trade and not be able to collect that funding arb if the price goes up. If the price goes down or sideways, then you're all good. But that is really the thing to manage, is that leg of the trade, making sure it isn't stopped out. And then obviously, if it is stopped out, what do you want to do with this side of the trade? Now, if the short is stopped out, it means that the price is going up. So you may just say, hey, you know what? I'm just going to keep the long position as a new trade, which is not a neutral trade, but it's basically long, and ride that out. Or if you really are, just wanting that funding arb, you have to manage that position. If you get stopped out of the short leg, then you have to sell out of the long straight away to make sure that you don't have any market exposure. A lot of people will trade ETH with this as well instead of Bitcoin, and there's a big reason for that, and that's because ETH actually pays staking rewards, which can up the yield that you're getting out of that strategy. So as an example here, you can see that Binance has ETH as around 3.66% from the funding rate arbitrage right now. So as you can see, their portfolio would sell ETH perpetual and buy ETH. Now, just from that funding rate arbitrage, you're getting 3.66% right here. So what we're going to do is exactly the same thing with ETH. So we can go to the ETH market here versus US dollar tether or BUSD. You buy an amount of ETH, that would be 10K or whatever you wanted. You would get that, and then you'd go over to the futures side and short that $10,000 position or whatever it is with ETH as well. Pretty much the same as the Bitcoin funding rate arbitrage. Now, the difference with ETH is that natively ETH pays a staking yield, which is around 4%. right now. Now that changes as well, but essentially what you're doing is taking a long position in ETH, short position in ETH, just like we saw with Bitcoin. You're getting the funding rate arbitrage, which, as we've seen on Binance right now, is, let's say, 3.66%. So that's from the funding rate arbitrage, but ETH actually pays a staking yield, right? So what traders can do right here is actually go and take ETH out of Binance and then go and stake it. They could swap ETH for staked ETH on Curve Finance or something like that. So ST ETH, you can buy it on Curve Finance or 1inch on decentralized exchanges. And so what they have is that ETH position that's in staked ETH that's also giving you, let's say, 4% as a staking yield. So even though you have long exposure spot, short exposure in the futures market, which should theoretically be a neutral position, there might be a spread that you're paying here by the time you get in and out of these positions, which is definitely one of the risks. It's going to take away from your yield. But, potentially at the moment you're getting 3 or 4% from the funding arb and 4% staking yield from ETH without having a long position in ETH on a net basis. Now, one of the other things you can do on Binance is actually use BETH, which is exactly this. Well, it's not exactly the same, but it's essentially the same thing as staked ETH, which is Binance's version of staked ETH. So what this is you give ETH to Binance. You can just buy it in the market. You don't need to stake it through their ETH 2.0 staking, but you can just buy BETH. And this is a position in staked ETH. So Binance stake the ETH and then pass the staking rewards back to you in your spot wallet if you have BETH in your spot wallet. Few risks here and downsides here is that, as you can see, the price of BETH is actually very different to ETH. You can see BETH is 1,159 and ETH is 1,200. So there's a little bit of a discrepancy there. The reason being is that as of making this video, staked ETH is still locked up. And so any staked ETH product, be it staked ETH or BETH, they trade at a little bit of a discount just based on the fact that it's locked up and there's some duration risk and other liquidity risks there. So that's a little bit of a downside for that. Also, you can see this market, specifically BETH, is not liquid. You can see it's just kind of doesn't trade a lot, right? And so it's going to be kind of more difficult to trade in and out of things. Just anything that is a liquid increases the risk a lot, especially spread risks as well when you're trading. Staked ETH is much more liquid, but then you have the risk of having to take that ETH off of the exchange onto your MetaMask wallet or something, and just having the two positions separated and having a kind of time. If your futures position gets stopped out, then having to put that ETH back into the exchange, and you having time risk there between the trades. But that is how people do it with ETH as well. There are certain risks about liquidity and trading here and the spread of when you're able to trade. But you can see taking a neutral position can yield a decent amount for traders that do want to implement that strategy. Another way to take advantage of price discrepancies between spot and futures markets is something called spread arbitrage. This is usually done by whales and much larger players, but it can be done as well on a smaller scale. So essentially what we're trying to do here is just take advantage of a price differential between going long in the spot market and then selling that position straight away in the futures market. Now, this only works for delivery futures and not perpetual futures, which there are some, at least on Binance. So I'll show you this. This is known as a spread arbitrage because we are just trying to immediately lock in a profit in a difference in price. So we can see this here. It's actually on arbitrage data and spread arbitrage, where we have quarterly deliveries of both ETH and BTC. So as you can see here right now, it's known as Contango when the options price is higher than the spot price. So we go long Bitcoin US dollar tether in the spot market. We immediately sell that position over in the quarterly delivery. Now that's about a few days. I think it's about 8 days away here. As you can see, 8 days away as of making this video. Now that can be as much as 3 months away, depending on what time in the quarter that you are. But we'll have a look in the real markets here. So as you can see here, the price in the spot market is 16,837. So you can buy an amount at that price, 16,837. And in the futures market for the quarterly delivery in 8 days time, it's trading at a higher price, 16,846. So buy at 16,837, sell at 16,846, and you just lock in that amount. And it's a very small amount, of course, but this is what arbitrage is just trying to take out small amounts in the market. Now on Binance, this quarterly delivery market, so not the perpetual market, but the actual quarterly delivery, you can get to that pretty easily just by going to, those symbols. You want to look at delivery and not perpetual. So you can actually get that via here, delivery, and then you can see the deliveries here. So there's only one at the moment, which is expiring, but then the next one will come up. So you want that here. Now, this is actually settled in Bitcoin. So what you would do, buy in spot, move that BTC over to the futures trading account. You can do that here by just transferring assets quite easily. And then you just sell for delivery at that time, settled in BTC. So you just sell short that amount, whatever it is that you have, and net off that position. And that's a very small arbitrage. Now, like you can see, it's a tiny arbitrage, right? It's not making hardly anything, but it's only a few days. And depending on the position size, just do it over and over again. It's just a way to, get an arbitrage out of the market. You can do this between spot and futures on one exchange. You can do it between spot and futures on other exchanges. This is what market makers do all day long, is they just buy lower than they sell on different markets for the same thing, so trying to take an arbitrage out of the spread in the market. The one thing to note here definitely is, because the yield is so low, you might get completely wrecked on trading fees. Now on Binance, actually, Bitcoin has zero commission, zero trading fees right now, so you don't have to worry about that. But if they put that trading fee back, then you have to worry about trading fees when doing arbitrages, because the spread and the trading fees are going to eat away at your profits. There are many risks to these arbitrages, and what we're trying to do is take the least risk possible. When you're trading in futures markets, you're trying that funding rate arbitrage, the funding could go against you, which is a risk. And so when you're trading that funding arb, you're not taking a delta position, but you are essentially trading the funding, and so that has to remain in your favor. There's also liquidity risk and trade spread risk, because every time you trade, the spread is there, and that's just eating away at your profits. Especially with small arbitrages, it can really wreck you and basically make the arbitrage kind of non-existent. There's also rug risk and app risk as well. Like if you're taking the staked ETH trade and then taking it out from an exchange, staking it, a lot of risks there in terms of what's the trade between spot ETH and staked ETH. Is that going to widen that spread risk again? And so there are risks, and definitely with leverage risk when you're trading in perpetuals is, are you going to get stopped out of that short leg? So there are a lot of risks, even with arbitrages. It's not that simple, but an arbitrage is supposed to minimize risk while taking out a yield from the market in terms of the price discrepancies. I'll leave the link to Binance in the description for that trading bonus. I'm James with MoneyZG. Cheers for watching, and I'll see you in the next one.